There's a type of trading mistake that doesn't feel like a mistake while it's happening. It doesn't feel like revenge. It doesn't feel like panic. It actually feels like the right thing to do, like staying active, staying sharp, making the most of the day. You're in the market, you're watching, you're engaged. You're doing the work. Except you're not. You're losing money in the quietest, most socially acceptable way a trader can lose money. By taking trades that were never there. Overtrading is the pattern that bleeds accounts slowly, consistently, and almost invisibly. Not in one catastrophic session, but across weeks and months of small, unnecessary positions that each had a reason, each had a justification, and none of them had a real edge. Today we're going into why it happens, who it happens to, what's actually driving it underneath the surface, and how to tell the difference between a trader who is executing and a trader who is just busy. Before we get into it, let's be precise about what it is, because overtrading gets misunderstood in a way that lets a lot of traders off the hook. Overtrading is not simply taking a lot of trades. Some strategies are high frequency by design. A scalper taking 30 trades a day inside a defined system with consistent edge is not overtrading. That's their strategy. Overtrading is taking trades outside your edge, outside your strategy. It's entering positions that don't meet your criteria, that you wouldn't take if you were asked to defend them to another trader. It's not because the setup is genuinely there, but because you need to be in something. That distinction matters enormously. Because the problem with overtrading isn't the number of trades, it's the quality of the decision behind each one. And quality degrades, measurably, consistently, the more you trade beyond what your system actually calls for. A study from the Journal of Finance found that the most active retail traders underperformed the least active traders by nearly 7% annually. Not because they were worse at analysis, because frequency without edge is just paying fees and spreads to feel busy. The market doesn't reward activity, it rewards patience and precision, and overtrading is the enemy of both. Here's something that most people miss about overtrading. And it's important because the fix depends on understanding the cause. Not everyone who overtrades does it for the same reason, and treating it as one single problem leads to solutions that only work for some traders and do nothing for others. There are two distinct profiles, and most traders sit closer to one than the other, though some carry elements of both. The first is the boredom trader. This trader isn't driven by greed or urgency. They're driven by restlessness. The market is quiet, nothing is setting up, and sitting on their hands feels wrong. So they find a reason to trade. Not a setup, a reason. A marginal candle pattern, a level that kind of holds. A stock that kind of looks like it's moving. Something. Anything. Because doing nothing feels like falling behind. The second is the greed trader. This one looks different on the surface. They've had a good trade, maybe a great one, and instead of banking it and walking away, the brain starts calculating. If I made that much on one trade, what if I take another? Or they exit a winning position and immediately look to flip it in the opposite direction, because they assume the move is exhausted and the reversal is coming. They're not trading the market anymore, they're trading their own P&L. Both profiles end up in the same place. More trades than the system calls for, worse average quality per trade, and a P&L that doesn't reflect the effort going in. But they got there from completely different psychological starting points, and that matters when it comes to fixing it. Both profiles have a neurological explanation, and understanding it explains why overtrading is so hard to stop even when you know it's happening. Let's start with the boredom trader. What most people call boredom in a trading context is more accurately described as dopamine deficiency. Dopamine is the brain's anticipation chemical. It fires not when you receive a reward, but when you expect one. When you're watching a live chart with money on the line, dopamine is flowing. Your brain is engaged, alert, alive to the possibility of a move. When the market goes quiet and no setup appears, that dopamine signal drops. And for some people, particularly those with naturally lower dopamine baseline or those who are wired for high stimulation, that drop feels genuinely uncomfortable. Not just boring, uncomfortable in a way that creates a real neurological pull toward doing something that restores the signal. Taking a trade, any trade, restores it. The moment you're in a position, the anticipation is back. The dopamine flows again, the discomfort lifts, and your brain files that away as a solution. Which is why the boredom trading pattern repeats so reliably. It's being neurologically reinforced every time it happens, regardless of whether the trade wins or loses. The greed trader operates through a different mechanism, but it's equally wired in. A winning trade produces a dopamine spike, a significant one, and the brain, having just experienced that reward, immediately begins seeking repetition. This is the same circuitry behind almost every compulsive behavior. The first reward primes the system to want another. Just one more isn't weakness. It's your reward circuitry doing exactly what it evolved to do. The most common way for a greedy trader to continue trading would be the flip trade, entering the opposite direction immediately after exiting a winning position. It feels like analysis. It's dressed up as a read on the market, but underneath it is almost always the same thing. A brain that just got a hit of dopamine and is trying to get another one before the feeling fades. Neither of these are personality flaws. They're predictable responses from a brain that was never designed to sit still in front of a screen and wait. The question is whether you've built a system that accounts for that, or whether you're trusting willpower to win a fight against neurochemistry. Now let's imagine you have a genuine trading edge. Your A-grade setups, the ones that fully meet your criteria, where everything lines up, win 60% of the time with a 1-to-1 risk-reward. Over 100 A-grade trades, that edge compounds beautifully. It's real, it's provable, it's a business. Now add overtrading. On top of your 10 A-grade setups a week, you're also taking 15 B and C-grade setups, marginal entries, boredom trades, flip trades after winners. These lower quality setups win maybe 40% of the time. Same risk per trade, worse outcome. Run those numbers over a month and something uncomfortable becomes visible. Your A-grade trades are generating consistent profit, but your B and C-grade trades are giving most of it back. Your net result at the end of the month looks like a mediocre trader, even though buried inside your data is the track record of a genuinely profitable one. This is the specific damage overtrading does that makes it so insidious. It doesn't just cost you the losing trades, it contaminates your data. It makes it impossible to accurately measure your real edge because your results are a blend of your system and your noise. You can't improve what you can't isolate. And you can't isolate your edge when it's buried under 20 extra trades a week that were never part of the plan. So how do we fix this? As we know now, overtrading comes from different places. The fix has to be tailored to which profile you're dealing with. The solution for boredom trading doesn't solve greed trading, and vice versa. If you're the boredom trader, the core problem is that you've trained your brain to associate the trading platform with stimulation. And sitting still at that platform without trading feels like deprivation. The fix is not to try harder to sit still. It's to redirect the stimulation elsewhere when there's nothing to trade. Define your criteria precisely in writing, specific enough that a trade either meets them or it doesn't, with no grey area where you can talk yourself in. When the market is quiet and nothing meets the criteria, close the platform. Not minimize it, close it. Then do something that engages your brain. Review past trades, read, study a setup from history, go to the gym if you usually go after trading. Give the dopamine system something legitimate to work with while the market does nothing. A daily trade limit also works well for boredom traders and also greed traders. Not because the number is magic, but because the constraint forces you to be selective. If you're only taking 3 trades today, you can't afford to waste one on a marginal setup. This deliberate selectivity will shift your focus toward proper execution, ensuring you only engage when your edge is there. Now, if you're the greed trader, the fix starts with a hard rule around winning days. When you've hit a predefined profit target, say 2% of your account, you stop. Not because you have to, but because you've already decided in advance that protecting a good day matters more than potentially adding to it. The market will be open tomorrow. The winning trade you just took doesn't expire. For both profiles, the post-session journal is the most important long-term tool. Tag every trade as A, B, or C grade at entry, before you know the outcome. At the end of the week, run the numbers separately. What you'll find will be more persuasive than anything I can tell you. Your own data, showing you exactly what your real edge looks like, and exactly how much the extra trades are costing you. Overtrading is so common because it doesn't feel like a problem at the moment. It feels like engagement. It feels like hustle. It feels like you're doing what traders do, watching the market, finding opportunities, staying active. But the market doesn't pay you for activity. It pays you for patience, precision, and the discipline to wait for the trades that are actually there and pass on everyone that isn't. The boredom that pushes you into bad trades is neurological. The greed that pulls you back in after a winner is neurological. Neither of them are character flaws, and neither of them respond well to willpower alone. They respond to systems, to pre-made decisions, to rules that were built when your brain was calm and are enforced regardless of how it feels in the moment. Know which profile you are. Build the fix that matches it. And then trust the data to tell you whether it's working, because the data doesn't lie, even when the feeling does.